So if you thought Federal Reserve Chairman Powell was joking when he says, I'm going to inflict pain on you guys, well, he wasn't, and that's baked into the details that we're seeing. So here's what we're seeing right now. If you're a first-time home buyer, you might want to put things on pause right now because the market is in shambles, especially when it comes to mortgage rates. So I'm going to give you my prediction at the end of this video so you guys can understand where I would be if I was a buyer in this market. So we see the headlines right here is Fed raises rates by another 0.75 percentage point, pledged to hike or fight inflation. Well, they're sure doing they're doing a terrible job in fighting inflation, but they're doing a fantastic job of crushing the housing market and crushing our portfolios if you have a retirement fund or any stocks. But what I reviewed last night was after the Federal Reserve came in, the bond market stabilized and the stock market, it plummeted, but I think I thought it hit a bottom. And then today's, everything opens, the market's open. Mortgage rates just spiked once again. We're probably going to see at least a 0.25% raise again today. So we're teetering now on the 7% range. If you would have told me that last year, I'd have said, you're completely nuts. There's no way we're going to go from 2.99 to 7. Well, it's here because Federal Chairman Powell inflicting pain on you guys. So let's get over. I read through the Federal Reserve transcripts last night. I'm not going to put you through a 20-minute dissertation of the transcripts, but there's 3 areas, and I'm going to go over them briefly to show you guys what I think the markets are, why the markets are reacting the way they are. And then we're going to get over the reason why you're here is where mortgage rates. Okay, so let's get into the details of the transcripts that might give us little insight in why the market's doing what the markets are doing. So here's the transcripts from Federal Chairman Powell's speech yesterday. And I just want to point out a couple different areas. It tells us, what they did and how they did it and everything else. But what I really want to focus in on is a couple different areas. You can see right here, this piece right here, growth. I'll try to put it up there so you guys can see it. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting low real disposable income. Remember I did a video talking about disposable income? I'll try to, if I can find it, I'll try to put it up here. It shows that our disposable income in 2021, the whole country was at its highest level ever. So what is disposable income? It's basically, how you get paid and then you pay your bills. What's that amount of money left over after the fact? The Federal Reserve considers that your disposable income. It was at its highest level ever in history just in 2021. So when you have that much money in the system, obviously it's going to create inflation because of that. So the Federal Reserve is trying to suck out that money to basically cure inflation. But let's read a little bit more into this. Activity in the housing sector has weakened significantly. That's their goal. And again, remember the video we did the other day. The housing or shelter is the biggest chunk, the biggest piece in the inflation number. So if they can take a chunk out of that, they'll drive inflation down rapidly in a big way just by crushing housing. So that's one piece of this puzzle. The next thing is we go down through here and they keep telling us about the jobs market. The jobs market is fantastic and everything else. So let's see right through here. The labor market continues to be out of balance. Okay, we know that. But if you go up through here, despite the slowdown in growth, the labor market has remained extremely tight. We all know that, with the unemployment rate near a 50-year low. So do you go past, on your way to work, if on your way to the store, on your way to the grocery store, maybe out to dinner, do you pass any companies, like manufacturing companies? Have you noticed that every one of them has help wanted signs or hiring? And we have bonuses and we have pension plans and we have everything and anything to entice people to come back to work. So how do we have such an imbalance in the job market? Job vacancies remain at historic highs, but wage growth has elevated. So we still have a disconnect in how many jobs are out there and the people working. Okay, I still blame that on a lot of the government benefits that are out there, but I'm not going to touch that because there are millions of people out there that need help. But I think there's a lot of people still sitting on the sidelines using up the disposable income that they used to have. That's getting depleted fast. So those are 2 areas. The other area, what I really want to focus in on, and I think this is the biggest point that they're getting at, is where do they want the federal funds rate? The rate that they control Where do they want that to be? So if you go down through this article a little further, it's going to give us insight in that. And I missed this yesterday, so we can see that right in through here. So at today's meeting, the committee raised the target federal funds rate by 0.75%, bringing the target range to 3 and 3.25. Okay, so that's where we're at right now. But where do they want to bring it to? That's my dilemma, because I want to figure out how much they need to raise rates going into this, so I can figure out what they're going to do at the next 2 meetings. And here it is. So if you go through this right here, you're going to read, and you might not. I missed this yesterday. You guys might miss it. As shown in the SEP, the median projection for the federal funds rate is 4.4% by the end of the year. Okay, so what does this tell us? Well, it basically tells us we're at 3.25 right now, and the Federal Reserve wants to get it to 4.4. So what does that mean? Well, it means they need to raise rates another 1.15%. So my tune's going to change a little bit. Again, guys, don't blame the messenger. What I'm throwing darts at, I feel like, is a moving target. So every day I get new data that makes my views change a little bit. I have no problem telling you guys that. So the next meeting now is projected that they're going to raise rates by 75 basis points. I projected they were going to do 50 basis points. It might not seem like a big deal, but it is a big deal, because those numbers, or when they jack up in interest rates, it's affecting us as consumers, but it's really affecting companies. And that's why you see companies or stock prices actually plummeting, because it's going to erode a lot of company profits, because higher cost of everything, higher costs on interest rates, where companies have a lot of financed stuff, and we saw just here, employment, wages are increasing, so they have wage increases, price increases, and now interest rate increases. That's why you're seeing the stock market really crumbling at this point. But the Federal Reserve is doing their job. They're crushing housing by increasing rates dramatically, and that's what's happening even in this report. So based on all that stuff, what in the heck is going on with mortgage rates? Because that's why you're here. So the first piece of this puzzle, let's figure out what's going on with the MBS market. This is the bond that trades on Wall Street that is the biggest. The yield on this bond is the biggest component of your mortgage rate. So what you're seeing on your screen right now is the mortgage-backed security bond trading on Wall Street. It's live. You're going to see it move. It's down. This is the price of that bond. It's down 47 ticks. What does that mean? Well, in its easiest forms, as this number goes down, unfortunately, interest rates go up. The bigger this number down, the bigger the rates go up. So this is probably going to equate at least to a quarter or an eighth to a 0.25% increase in rates today. So where did rates end yesterday? So we can figure out where they're going to be maybe later this afternoon. And for that, we go right over to here. Here's the top 6 mortgage products used out there by consumers. If they're looking to buy a house, maybe refinance or whatever. But here's the rates. These are not my rates. These are rates issued by Mortgage News Daily on a daily basis. This is the national average for a client that was looking to do this. If you were a person out there looking to buy a house, and it was a $500,000 home, you have a 740 credit score, you're going to put 20% down, or whatever would be required for one of these programs. It was a single family home, going to be your primary home, legal purposes. This is what your rate would be based on one of these cells. You can see here the 30-year fixed rate now is 6.36. It just teetered on 6.5 yesterday. They're saying it's down 0.11. I didn't see that big of a rally in the market yesterday, but maybe some of the lenders didn't reprice or didn't readjust their rates after yesterday's meeting. So now that we're seeing this, but we're going to probably teeter on the 6.5% range as soon as rates do get issued today. So what happens is banks accumulate all the data that they have in the morning, check the bond market, check everything else, and then they issue rate sheets. This is based on yesterday's rate sheets because it's too early in the morning for banks to actually post yet. So my name is Dan Frio. What am I? Who am I? Am I a realtor? Am I an advisor? I'm actually a mortgage person. So if you're out there in the country, anywhere out in the country, I'd love to be able to help you. I'm licensed all over the United States as well as Puerto Rico. So if you're in need of a mortgage, check us out. Check me and my team out at therateupdate.com. You can find everything you need there to figure out how to contact us. There's going to be a phone number. There's going to be a calendar event or calendar Calendly, so you can click in there and schedule a meeting. And there's even a chat bot that we have live. If you have a question and you're on there, please ask any questions that you have. So God bless, guys. Thanks so much for watching. Remember, if you podcast, check me out on your local or your favorite podcast. Just Google or search Dan Frio or The Mortgage Update with Dan Frio. You'll find me, yours truly. I hope you enjoyed it as much as you do my YouTube channel. So thanks much for watching. God bless. I'll see you tomorrow. Bye-bye.